Hello, Happy New Year, and welcome to this week's Private Funds Update. I'm Sandra from SmartEsq. I am here to share with you the highlights of what I learned during the holiday break. We begin with the most significant deregulatory development from the CFTC to private funds in over a decade. On December 19, 2025, the CFTC staff issued no-action relief from commodity pool operator registration for SEC-registered investment advisors to certain private funds. Effectively, this reinstates the old Rule 4.13(a)(4), an exemption previously provided for managers to private funds offered solely to qualified eligible persons, defined as classes of highly sophisticated individual and institutional investors. For years, SEC-registered advisors have been forced to rely on the de minimis exemption, which strictly capped commodity interest trading at low thresholds. This created a compliance trap where even a small hedging transaction could inadvertently trigger a full CPO registration requirement. That trap is now gone. Under the new relief, registered investment advisors can claim an exemption without any trading limits, provided three conditions are met. First, the fund's manager must reasonably believe that each investor in the fund is a qualified, eligible person. Second, the advisor must file a Form PF with the SEC. And third, the fund must be exempt from registration under the Securities Act and sold without marketing to the public in the United States, unless offered pursuant to Rule 506(c) of SEC Regulation D. This is a strategic game changer, particularly for private credit and closed-end funds. Managers can now use interest rate and currency swaps aggressively to hedge portfolio risk without fear of regulatory footfalls. Furthermore, unlike other exemptions, this relief does not require you to offer investors a right of redemption. The relative calm surrounding the Corporate Transparency Act is over. In a year-end ruling on December 29th, the 11th Circuit Court of Appeals upheld the constitutionality of the CTA, reversing the lower court decision that had given many managers a reason to delay compliance. For private equity firms, this signals significant regulatory whiplash. It is now widely expected that FinCEN will rescind its interim final rule from last March, which had temporarily exempted domestic entities. This will bring thousands of Delaware-domiciled SPVs, blocker core, and GP entities back into the reporting fold under the CTA. CCOs and legal teams should resume the collection of beneficial ownership data, including passports and addresses, to avoid a compliance bottleneck when the rules are officially reinstated later this year. In a rare bit of positive news for privacy, New York Governor Kathy Hochul vetoed amendments that would have expanded the New York LLC Transparency Act. This prevents the creation of a duplicative, publicly accessible state registry, keeping that data restricted to law enforcement. Finally, in late December, the EU reached a final political agreement on the Retail Investment Strategy, or RIS, and for those looking to tap into the democratization of private assets, the package is a mixed bag. The most pressing development is the introduction of value for money benchmarks. The EU will now use supervisory benchmarks to cap costs. If a fund's expenses exceed these levels, it may be barred from sale to retail investors. For sponsors of European long-term investment funds, or ELTIFs, this poses an existential risk. Private equity and credit structures inherently carry higher expense ratios than passive ETFs, and there is no guarantee yet that these benchmarks will account for the structural costs of managing liquid assets. Additionally, the EU has introduced a new inducement test. While a total ban on commissions was avoided, distributors must now prove that any commission received actually enhances the quality of service to the investor. This adds a layer of compliance friction that will complicate the distribution of private funds through European banking networks. However, there is good news regarding the opt-up professional investor thresholds. The criteria have been eased. To qualify as a professional investor, a client now needs to meet two of three new criteria: significantly lower transaction frequency requirements, a portfolio size of just €250,000, down from €500,000, or, crucially, proof of relevant education or training, rather than just work experience. That's it for this week. You can learn more about these topics from me on the SmartEsq platform. If you are curious about the services we offer, please visit www.smartsq.ai.